Hello and welcome to the State of the Fleet Industry, a weekly video series produced by Automotive Fleet magazine. I'm Mike Antich, editor of Automotive Fleet, and today I'd like to examine what's occurring in the fleet industry for the week of August 31, 2020. And today I'd like to start our discussion about some positive economic news that just came out last week. And as I stressed in our past reports, always go back to the source document to analyze the data and not rely on other people's opinions. So today I'm going to be looking at a U.S. Commerce Department report. It was released last week and it's on consumer spending for the month of July. And the good news about this is that the numbers came in better than expectation, and that's been a common theme with a lot of these recent government reports. The numbers have been coming in higher than expectation. So why is this a good news? Well, it's good news because consumer spending still represents 75% of the economic activity in the U.S. So that's 75% of our GDP, gross domestic product, is tied in with consumer spending. And that's a good indicator that this economic recovery is continuing and it will proceed forward. So one segment that's benefiting from the strong consumer spending has been the new vehicle sales in the retail market. And here, sales activity has been extremely strong. I know in talking with dealers, that area is just really on fire at the moment. What's really strong are trucks, and also there still are inventory issues as factories are still ramping up and getting vehicles on the lots to dealers. But it signifies that there's still strong pent-up demand, and the inventory at dealerships is still somewhat constrained, although that will be rectified in the coming months. But for the near term, let's anticipate that sales activity in the retail market will be continuing. Another event that I like to examine is the recent Hurricane Lora, which made landfall on Thursday, August 27th, morphing into a Category 4 hurricane. And its initial trajectory put it on course to hit the part of the petrochemical industry on the Gulf Coast for the states of Texas and Louisiana. And in particular, there were 9 refineries that were vulnerable. These were all shut down prior to the storm, but luckily, as a country, we dodged the bullet. The storm veered in another direction, sparing these 9 refineries, which were shut down, but they've all become operational the following day. And the reason that's significant is sometimes you get a glimpse of the vulnerability of this industry. If those refineries had taken a direct hit, the potential was that there could be damage, there would be downtime, resulting in spot shortages on fuel and resulting in higher fuel prices. And we've seen this before. This has happened. The outlook for that industry as a whole continues to still be very bearish. In fact, the industry itself is predicting that oil demand will not return to pre-pandemic 2019 levels until 2022. And it's significant for the fleet industry because the oil and energy business represents a major component in the overall fleet industry, but it is a two-edged sword. What's bad news for the oil and gas industry is good news for the rest of us, which is buying fuel. And it points that fuel, due to this lower demand, the prices should remain stable. And another observation that I wanted to make is in the past several decades, the number one issue with fuel prices has been fuel price volatility. And I ask myself and ask yourself, when was the last time you remember experiencing fuel price volatility? And we haven't seen that in years now. And in fact, this is one of the longest periods in history where there has been fuel price stability. And a key reason for that is the U.S. is now pretty much energy independent. It's not vulnerable to these outside geopolitical factors. So what is the forecast for future prices? Well, in our industry, in the fleet industry, the gold standard for determining that is the U.S. Energy Information Administration. So again, going back to the source, if we look at current gasoline prices, they're averaging about $2.12 per gallon on a nationwide basis. The government forecast for calendar year 2021 is that the average retail price of gasoline will be $2.23. So modest increase, but still relatively stable, and it's very good news for fleets, especially as we're now all preparing our 2021 fleet budgets. The good news is likewise there for diesel prices. Currently, diesel prices are $2.42 per gallon. And that's actually a decrease from same time last year. Last year, it was $2.93 per gallon of diesel. So close to a 51-cent decline in fuel and diesel prices. So let's drill down and examine what is the current state of the commercial fleet market in the U.S. And as a result of the proliferation of telematics devices in a number of vehicles, millions of vehicles, and across a wide cross-section of industries, we now have the critical mass to make real-time assessments, broken out by industry if we want to, but make real-time assessments on what is the vitality of the commercial fleet marketplace. And the metric that's commonly used is total miles driven. And one company that does this is Geotab. Geotab uses February 2020 as a baseline. That's prior to the COVID-19 virus being declared a pandemic. But when you use February 2020 as a baseline, how does our current month, August 2020, compare? And it's actually very good news, very revealing. You know, total mileage in August 2020 is actually 103% of what it was in February 2020. So that is a good indicator that many companies operating large fleets in this country have made a good recovery. And another company that tracks the same data is Donlen. Donlen uses a little bit different baseline. They track, they're tracking, let's say, August 2020 miles against same time last year. So they're tracking it against August 2019. And when you look at the Donlen data, it shows that overall fleet mileage for August 2020 is about 87.4% of what it was in August of 2019. And if you remember, you know, August of 2019 was a very robust time in the economy. So when you break it out when you break out current data, the August 2020 data by industry segment, where is most of this activity occurring? You know, one of the key areas is the construction industry. Construction vehicles right now are operating at 100% capacity of what they were operating in August of 2019. So a dramatic recovery, a very robust part of the U.S. economy, very important to fleet because they're really one of the largest segments in terms of buying fleet pickups and vans. You know, another area where there's dramatic improvement has been with utilities. They're 103% in terms of total miles compared to August of 2019. Health services, 105%. Companies involved in heavy construction, 114%. These are all the leading industries that have over 100% or more miles driven in August 2020 than they did in 2019. Now, there are still some industries that are still in a distressed mode. A key one that we've cited now is insurance. Insurance is only 46% of miles traveled in August 2020 compared to August of 2019. So, you know, and the insurance industry is still struggling in that regard. So to close this presentation, let me just give a brief assessment of what's going on in the current wholesale used vehicle market. Prices continue to be strong, although inventory is increasing, which is prompting some analysts to predict that there would be a softening in prices as the amount of inventory starts increasing vis-a-vis overall demand in the market. But nonetheless, things are looking good on the wholesale side. Next week, we're going to be examining the August jobs report. It's going to be big news. That'll be released by the U.S. Bureau of Labor Statistics on Friday, September 4th, this Friday. And that'll be a good indicator of the type of recovery that we can anticipate for the third and fourth quarter of this year. So until then, this concludes my State of the Industry presentation for the week of August 31. Thank you for listening.